I would think it's the financial problems that cause the failure to deliver. The realization, again, pointing to a bail-in. If we see a bank bail in, you're going to see mass hysteria where people who never would have thought about gold and silver are saying, holy shit, I need out of the system now, out. And that was what it was like when these banks were being bailed out. When they're bailed in and people understand the systemic nature of one bank pulling down several others, we haven't even talked about the insurance companies in that environment, but or the brokerages, but yeah. And so, yes, I think that will on the physical demand side from retail side or from the investment side, I think that's enough demand to sway the tables dramatically. We're already seeing massive increase in green and renewable energy type of demand for silver. And let's not forget, we've depleted all of our artillery, lots of it, sending it off to the Ukraine. And as I've said many times before, Google it, almost exactly 500 ounces in the tip of every Tomahawk cruise missile. So when you're talking about, advanced weaponry and guidance systems, it all needs silver too. So between military and industrial and monetary demand, it's off the charts. Ultimately, when that happens, I think it really, you're going to see a squeeze on the COMEX and a squeeze on the LBMA where everyone rushes to take what is available before it's not.
Well, think about it, Dunning. Why the hell would anyone keep their money in the banks? I mean, how many times should we say this? The average yield right now on a savings account in the United States is still under 0.5%. It's like 45 basis points you're getting on an average yield in a savings account here in the U.S. right now. Why would you keep it there when you can move it to a money market account at a too big to fail bank, supposedly, earning 5% with daily liquidity? You wouldn't. Or go directly to treasurydirect.gov and buy short-term treasuries directly from the government, where you sidestep all of the systemic risk. You're getting paid 10 times what you're getting in a savings account and eliminating all the risk. I mean, it's insane that these banks are even really as solvent as they are. And the indictment to the whole banking system is seeing, it's not Fitch saying that Bank of America and JP Morgan could be downgraded. It's that you're seeing huge redemptions or transfers out of the commercial banks by the big money going directly to the Treasury and relying upon the risk of the U.S. government versus the systemic nature of the banking industry. They're going right to the Treasury. They're getting high yield, higher yield than you can even get in the money market accounts directly from the Treasury at treasurydirect.gov. And in doing so, they are eliminating the risk of the banking sector. Here again, a self-fulfilling prophecy where it continues. The exodus chasing yield is the poison pill to the banks. The more deposits they lose, they get closer and closer to that point where they have to, as you say, sell their toxic assets, which put Silicon Valley Bank out of business in 36 hours. So, this is a deal that we haven't seen the end of yet. And you and I have said one phrase quite a bit over our last few talks, and that is recency bias or normalcy bias. People are infected with recency bias or normalcy bias, and that's the wrong thing to do, especially when you're 80 plus years old, thinking about playing shuffleboard and golf and retiring on your assets that, have been blown sky high due to suppressed interest rates and easy money. It's make-believe. It's Alice in Wonderland. And when you find an environment where those assets correct in terms of proper valuation, where price discovery is something that isn't such a mystery, then these retirees are going to be bagging groceries again and wishing that they would have not risked their retirement, really, to speculation in what amounts to maybe the most overvalued, over-leveraged, unstable, ultimately in terms of its fundamentals, set of traditional markets that I've ever seen in my career. So, yeah, it's a question that you'll get asked, but most people are incapable of hearing. And even if you tell them, they'll think, you're just a doom and gloomer, you sell gold. Well, unfortunately, people have this opinion that capitalism, being someone who sells gold for a living, and honesty and good intentions have to be mutually, exclusive of one another. And yeah, you can be a great gold salesman, but your intentions are pure and your motivation is sound and logical. And, I would just simply say to you that most people, unfortunately, will not understand what you're saying until they see it with their own eyes. And by then, it's too late. So those who listen to you that reluctantly prepared, you're doing them a favor. And you look at the numbers, you look at the fundamentals, you look at the logic, you look at the history. In a world of probabilities, I would say that there is going to be a moment that will, as you said, catch many people off guard because they don't see what's coming straight at them. And you can't get out of the way of what you don't see coming.
Some emergency liquidity, which is always, from a preparedness standpoint, absolutely. Have some food on hand, have some water on hand, have some cash on hand, absolutely. But beyond that, as far as storing your nest egg in paper cash, being a way to escape what's coming.
Yeah, I mean, the only thing that it helps you escape a little bit is the counterparty risk. And when you're getting paid next to nothing in return, what is the opportunity cost of having that cash rather than at the bank? But look, when you talk about the Fed's mandated target of 2%, I never understood that. I mean, why have 2% inflation? How about negative 2%? The lower the level of inflation, the higher the standard of living. And it would be like Elon Musk standing on the stage saying it's the goal of Tesla and SpaceX to lose 2% per year. Isn't that great? No, that's stupid. But the reality of it is that 2% mandate, they never hit it. And because the metrics by which they gauge that 2%, even when inflation was supposedly 2%, was probably much higher, according to John Williams, because they strip out those things that would betray or shine a light upon their faulty logic and their faulty set of measurements. And so 2% every single year begins to erode considerably. But when you realize that inflation is 2, 3, 4, 5 times that and has been for quite some time, the cash that you keep at home should be used for nothing other than emergencies or you need cash to go do something. But pulling out $100,000 in cash has its own set of risks. And you look at a country like Australia, who's moving completely cashless. And how far away are we from a situation like that? Certainly with Fed now being introduced and ultimately a CBDC and talks of a cashless society, central bank digital currencies, certainly we're beginning to see cash used less and less and less and less. I don't know that that's really the option. I do think people should have cash at home, some in small bills, not hundreds, but not 50s, but 20s, 10s, and 5s. But how practical is it to keep all of that money at home, and then when you need to send a wire or a check, you have to go deposit the money back in? That's probably not the answer. What the answer is to do the best you can to mitigate your exposure to a system that is fracturing and that the rating agencies are downgrading and are reluctant to do it because of the political aspect of it, where Janet Yellen chastises Fitch for downgrading the U.S. debt. And, quite frankly, they should have been applauded, as should have Moody's. And, one of the things that caught my attention was the senior analyst at Fitch who said part of the reasoning for downgrading wasn't just the debt, but was also the governance, the way that things are being done, where since 2019, our national debt has doubled from 22 to 32, nearly doubled. And, that's 50% greater from that period of time, 22 to 32, pretty damn close. And so you're talking about a situation that is becoming rapidly unattainable. And the byproduct of this will be the banks that get caught in the storm or in this cascade of higher interest rates and the consequences we find associated with that. But don't think that the pension funds and the insurance companies are immune to this. Where do they invest their money? On these sets of criteria where, everything has been thrown upside down. There's nearly, I think, a $1.8 or $9 trillion pension shortfall in this country. So, look, this is not a situation where people should just rest on their laurels thinking that it's always been okay and this time it will be too. Maybe it will. Maybe they're able to pull a rabbit out of the collective hat. But For my money, no. I think it's time for critical thinking and thinking outside the box at that.
Yeah, that's the other thing that a lot of people have been lulled into sleepwalking about, is thinking that whatever their pension plan is somehow going to take care of them, whether that a significant element of that is Social Security. Nope. You read carefully what's being written by the officials about Social Security, and they're saying they're going to have, within like 13 years, you have to start curtailing the amount of payments, and they're deflating, they're inflating the currency to reduce the value, the purchasing power of the payments, and the cost of living adjustments based on Cook numbers not keeping up with the real purchasing power. So no matter how you look at it, and then the other actual pension plans that are paying out these fixed benefits to people, not going to be able to stay above water either, with their bond portfolios going upside down, etc. So a lot of the hope and faith that a lot of people have placed, and perhaps with some well-intended guidance, or perhaps also with some cowardly theft of the Social Security Trust Fund by Congress, et cetera, along the way, has led up to exposure of a vast majority of retirees to be I think, at financial peril going forward. And I don't think they're being told about this.
Of course not. And, Reuters came out and said that by 2030, I think that, all in all, Social Security will be all but insolvent. Well, I mean, it already is, if it's $77 trillion underfunded, filled with IOUs. Remember, 1 trillion seconds ago, I always say 31,688 years ago. I mean, how do you ever fund Social Security, which has been pillaged? This is part of the reason why you've been hearing me kind of go out on a limb lately and ask the question, how much of this was intended? How much of this do they want to blow up? Because the majority of the debt that is owed by the United States is to the American public. Medicare, Medicaid, Social Security, and government military pensions, which represent a mountain, $130+ trillion of 4 times the national debt. And, if you blow it up and issue a central bank digital currency, it's a lot easier. Lael Brainerd, the modern monetary theorist, number 2 advisor to the presidency, a lot easier to go full modern monetary theory and make everyone whole if they take the new central bank digital currency after everything blows up. I'm not saying that's going to happen or that's the playbook. It's just there's a lot of that makes sense to me. All I can simply tell you is that if you are reliant upon those types of entitlements, like Social Security, to fund your retirement, I have a sinking feeling that, it's not going to be a good experience for the majority of the people in this country who are already not in retirement. It's going to, we'll be lucky at all if it's there. And then if it is, what is the value of the dollars you're being paid with? So this is all real, and you don't have to be a gold salesman or a doom and gloomer to say this. Google it. Go to Reuters. You'll see it yourself. Google the 2022 United States balance sheet, and you'll find that it says we have $155 trillion in debt, backed by $5 trillion in assets, of which 40% is student debt. So, I mean, we are woefully underfunded by debt to GDP standards. We're a banana republic. The bottom line is that things are changing, and if you don't sense it and see it and feel it and think that everything will be okay just by embracing what always has worked, well, then I think that's a gamble that I personally wouldn't be willing to take or advise my loved ones to take.